And aloha, hello, welcome to another episode of Market Analysis with Pablo Ahimon. And I'm just trying to bring you guys a relaxing background so no one freaks out about what's happening in the market. Now, the thing is basically, last episode we were analyzing what stocks, risk assets such as stocks and Bitcoin would do in a market environment such as right now, where we have high inflation and the Fed is about to tighten. So the market's conclusion, I'll just jump straight to the charts so we know that this is not a nature video. And by the way, guys, these videos go out to my Discord members first, and then I put it up on the internet so everyone can see it a few days later. So, okay, so without further ado, basically, last time we saw that interest rates, every time when the Fed says there's a lot of inflation, we're going to tighten interest rates, should we be scared? Do we think the market is going down? Well, not so much. But I think this time is different because previously, every time we see the blue line here, that's interest rates. When interest rates were rising, stocks were also rising. And stocks are actually a reflection of how risk assets will perform. And Bitcoin and crypto are, of course, risk assets. So I said, but however, this time is different. This time is different because now we have 8% inflation. All the examples people were comparing to, all the other commentators, economists, TikTokers were comparing to, was when inflation was only around, say, 2%, less than 3% in the last number of years. But now, basically, we're looking at 8% inflation before the invasion of Ukraine. So that means inflation could get a lot worse. And how then would the Fed tighten? And how then would... Okay, so basically we're going to have a look at the 1970s. And here's the thing. So why are we looking at the 70s and not the recent last 40 years? Because there was a lot of inflation. See, the yellow line here is inflation. And basically, if we see inflation was, going all the way back now, got up to around 10%, kind of comparable to where we are right now. And again, so the blue, sort of light blue line here is interest rates. We see that in 1972, as inflation was shooting up, interest rates was moving up. However, the stock market was also moving up, and then it came down. Again, this is the famous Volcker moment, as interest rates was again rising because inflation was already high. Stock market kept on rising as well, and kept on rising and didn't really pull back until much later. Now, so does this confirm that even when inflation is really high, even back then, like when inflation was really high, would rising interest rates not crash the market? Okay, this seems to confirm it, but I have a question. And I think I disagree with what the majority of them, well, a lot of what people in the market are saying. They're saying that, okay, look, as interest rates are rising, even when inflation was really high, and here's when interest rates got up to, say, around this is like 19%. Interest rates got up to 19%, the famous Volcker moment, because it's named after Paul Volcker, who was the Federal Reserve Chairman of the United States, kind of like where Jerome Powell is right now, but except in the late 70s. And even then, basically, it didn't kill the market. The market kind of went sideways. Now, there are two arguments I would provide against that. One is, first of all, back then in the 70s and in the 60s, look at this chart. You have basically, this is 1973, and the SP 500 is at 71. And then it got up to a high of 107. So between 171, 107, it basically ranged for about 16 years. See, even in 1982, we're still back to 106, 107. So essentially, it stayed kind of more or less in this range for 19, 18 years. Now, for 18 or 19 years, how much more can you go down? Essentially, the stock market was almost going sideways. And then that's compared to the situation we're in right now. Yeah, that looks pretty scary, doesn't it? I mean, that's not even the year 2000. So this is the stock market of where we are right now. Yeah. I'm sure there are a lot of wow reactions in front of the laptop right now. So essentially between say 97 to 2009, for those 12 years, market went sideways. Here's the famous 2000.com crash. Here's the famous GFC 2008 crash. And then since then, from March 2009, market has just gone, berserk. It's basically gone up 6.5, 7 times. That's just the SP 500 alone. We're not even looking at NASDAQ and tech stocks, right? Massive 12-year run. And so would you say that this situation is very, very different to what happened for those 19 years in the 70s, where the SP 500 essentially went nowhere? So now, if they are to raise interest rates, what do you think would happen to the stock market? And if stock market goes down, what do you think would happen to Bitcoin and crypto? Keeping in mind that Bitcoin and crypto and NASDAQ, the tech indexes, tech stocks are sometimes highly correlated. Recently, we've seen Bitcoin go down 53%, and now NASDAQ today's March 15th, that's when I'm making this video, is actually down 20%. It's confirmed a bear market. Now, that's one thing to keep in mind. So that's why I disagree with what everyone's saying. Second thing to keep in mind is what we said in our last video, which is, see this purple line here, this is how much QE or QT the Reserve Bank of America is doing, the Federal Reserve is doing. So as it gets going down, that means the Federal Reserve is not printing money, but it's actually withdrawing money, doing the opposite of printing money, withdrawing money out of the markets. Now we can see that last time they did this, basically SP 500 went down 20%, confirming a bear market. NASDAQ went down even further into a bear market. And this is, if you remember, this is at the actually at the end of 2017, start of 2018, and we all remember what happened to Bitcoin. Let me just put the Bitcoin chart up here. Bitcoin USDT now. New price scale. Okay, so let's have a look. And of course, Bitcoin at this period, when okay, I'll change the color on Bitcoin. I'll change it to say red so we can all see it better, and I'll change it to a candle chart. So okay, here we can see Here we can see that it's blurred in with the rest of the chart. So let me change that back to the line chart. Okay, the red. Okay, the purple as QT is coming, quantitative tightening, which is the opposite of printing money, which is taking money out of the market. It's taking more and more money out of the market. This is the red line. So Bitcoin went from Bitcoin actually went from 20,000, right, all the way down to like 3,500. That's a major crash in Bitcoin. Last time they went into QT, and so did the SP 500 crash as well. So now you got to ask yourself, if there's going to be QT, because the Fed says there's definitely going to be QT this time, are we still that confident that the markets are going to rise as interest rates are rising? I'll give you one more clue of what I'm thinking. Here's an article from 2017 that says Fed balance sheet reduction. That's what we mean by QT. It's the opposite of QE. Quantitative easing is when you print money to buy bonds. Quantitative tightening is when you sell bonds, right, to basically suck money out of the market, right? So Fed balance sheet reduction almost always end in recession. And that was written in 2017, August 2017. See that? Now, let's have a look at this article. It says, in 2017, the Fed's about to try something that almost always ended in recession. And let's see if their prediction was right or not. So we'll look back in August 2017, they wrote this article, which had been August the 2nd, 2017. See, that's here. They wrote the article here, and basically the Fed started, balance sheet reduction or quantitative tightening, and look what happened to the Fed, to cryptos when Bitcoin went from 20K down to 3K, right? That's like what, a 85% fall in Bitcoin, and what happened here with stocks, 20% fall. But that's the SP 500. So NASDAQ, tech stocks went down even more. Keep that in mind. And why is this article important? Now, and not only was it correct, but also correctly predicted what was going to happen 12 months down the track. What happened in 2018, if we only listen to this article. So basically, and see, you can tell this is articles from 2018 because it says the Fed balance sheet stands at 4.5 trillion, which means the Federal Reserve printed something like 4.5 trillion dollars. Guess where it is right now? The Federal Reserve has doubled that now after the COVID pandemic. It is now holding something like $9 trillion. And so, look at this. Look at what it's saying. It basically says it's an ugly track record here. Ugly track record. Virtually every time that... I kind of highlight this. Virtually every time the central bank has tried in the past, recessions have followed, right? So now it says in the past, Fed has done QT in 1921 to 1922, 1928 to 1930, and that's obviously caused the Great Depression of 1929, 1937, 1941, 1948 to 50, E2000. And it's saying Fed's going to try this again in 2017, right? As that's when the article came out. And then in 2018, we just saw what happened. Bitcoin crashed 85% and stocks crashed into bear territory. Now, so do we think this is going to happen again this time? So this is why I'm saying the situation this time is kind of different. It's not like before. So basically, this is where we are now. And I'm saying, two things are kind of different in the current environment. One is that inflation, as we can see, has shot up really high. So comparing to, the 2000s doesn't make sense anymore. And so we got to compare to when inflation was really high back in the 70s. And back in the 70s, we just saw that stock market also rose as interest rates were rising. But however, the problem is this. Back then, they didn't have something. One, stock market was going sideways for about 16, 19 years. Now stock market has gone up 6x since 2000 in the last 12 years. And also, I mean, look at the this is the SP 500 low of 2280 and a high of 46. So the stock market, 48. Stock market more than doubled in the last 2 years since the pandemic. I mean, that's already done way more than what the stock market was doing back in the 70s. So with the stock market this high, this overextended, and everyone's been saying, from Warren Buffett to Ray Dalio, saying this is probably overvalued. In that scenario, if they raise rates, you got to think maybe that's got to have a more effect of bringing the stock market down than, say, the 70s. The other thing is, back in the 70s, they didn't print all this money. Look at this money. Look at all this printing, right? I put it on a larger scale so you can see. This part is before 2008. GFC ran into trouble. They QE'd or printed money 3 times. QE1, QE2, QE3, and then, the market and the economy has recovered a little bit, so they stopped printing, and they said, we're going to QT. So they basically sold their bonds and took some money out of the market, and instantly there was a crashing in stocks and a crashing in Bitcoin, and now they printed twice as much in 2 years. So you remember this took how long? This is 2008 up to 2014, 6 years to print this much, and then they printed twice as much, right? 4.5 trillion, and then they printed another 4.5 trillion in 1.5 years. And now they're going to need to get rid of that quickly, because now we're facing, unlike this period here, unlike 2008 to 2016, we're not facing like 2 to 3% inflation. We're looking at 8%, 10%, 12% inflation. So my view on this is basically, look, no one can be 100% on what happens next. But at least I would say that basically maybe the voices saying that, the market is not going to do anything. Basically, the market is going to rise as the Fed QTs, as the Fed raises the interest rates because they look at the past. I just want to ask, have you really looked at the past closely? I think if you examine it closely, taking into account of how QT is going to happen, and every time the Fed does QT or quantitative tightening, US goes into a recession, right? It's happened 7 out of 7 times now. And also with inflation this high and the stock market this extended, if they start tightening, if they start raising interest rates and QT, do you still think stock market will keep on going up after a brief pause? I don't have a crystal ball. I can't be 100%. I would at least conservatively, if I was to bet, I would at least say it won't go up as much as it did before. In fact, I'm thinking best case scenario, it goes flat. Like maybe a 5% chance it goes up a little bit, make a new all-time high, maybe by 5%, 3% makes a double top. But more than likely, it's going to go swing wildly, fluctuate sideways, or it's probably going to tank. I could be wrong. This is a matter of probability. So I'm just showing you all the facts, and I'm saying that what people are saying in the markets probably doesn't make sense for this cycle. This cycle, there's going to be a lot more downward pressure. I'm thinking something like 40-45% chance stocks and crypto swing sideways around here. But something like a 40-45% chance, 50% chance stocks, even SP 500 goes into a bear market. Bitcoin goes below 30K. Whether it ends up at 23K, that's where the first level of support is, or 20K, or even lower, who knows, right? It's difficult to make an exact prediction. And I would say there's probably a 10% chance or less that stocks and Bitcoin actually makes a new all-time high in the next 4 to 5 months. Maybe, I don't know, there's a war, or maybe COVID gets really bad again and the markets rebound again, say, and the Fed starts printing again. So we throw everything out the window, Fed starts printing like there's no tomorrow again, and everything rebounds to a new all-time high by the end of the year. That would only happen in an emergency situation where there is, say, no more, say there's a massive war, or there's a massive COVID black swan type event, and the Fed throws all caution about inflation out the window and decides to just basically save the market at all costs. That could happen, but it's a small chance, and that would happen at the end of the year. If a black swan event is to happen in the next 4 to 5 months, I'm thinking sideways chop, lots of volatility, and 40% chance, 40 to 50% chance actually goes down lower into a proper bear market. Okay, thank you for joining me, and I'll catch you in our next session.